Silicon Valley Bank wasn't just another financial institution. Founded in 1983, SVB became the go-to bank for startups and venture capitalists. It provided the fuel for countless dreams, funding innovations that reshaped our world. From the early days of the internet to the rise of AI, SVB was there, a silent partner in the tech revolution. SVB's deep understanding of the tech sector set it apart. It didn't just offer traditional banking services, it provided tailored solutions for the unique needs of startups. However, beneath the surface of this success story, cracks were beginning to appear. As interest rates began to rise, the stage was set for a dramatic fall from grace. The collapse of Silicon Valley Bank serves as a stark reminder. Even institutions deeply embedded in success can falter. The seeds of SVB's downfall were sown in the changing macroeconomic environment. After an extended period of low interest rates, the Federal Reserve began to tighten monetary policy in 2022. This shift towards higher interest rates had a profound impact on the banking sector, particularly for institutions like SVB with large portfolios of long-term bonds. When interest rates rise, the value of existing bonds falls. SVB, heavily invested in long-term bonds during the era of low rates, saw the value of its assets decline as rates climbed. Adding to the pressure was the rapid growth of SVB's deposit base. SVB's investment strategy, heavily weighted towards long-term bonds, proved to be a mismatch for its increasingly liquid deposit base. The interest rate environment exposed a critical vulnerability in SVB's business model, a concentration of risk in a single sector, the tech industry. As interest rates climbed and the tech sector faced headwinds, SVB's fortunes began to turn. The first cracks in SVB's facade appeared in early March 2023 when the bank announced significant losses on its bond portfolio. This announcement, coupled with growing concerns about the bank's financial health, triggered a chain reaction among SVB's depositors, primarily tech startups and venture capital firms. Fear and uncertainty spread like wildfire through the tightly knit tech community. What began as a trickle of withdrawals quickly escalated into a full-blown bank run. Depositors, fearing the safety of their funds, rushed to withdraw their money, overwhelming SVB's ability to meet the demand. Within 48 hours, SVB experienced over $42 billion in withdrawal requests, a staggering sum that dwarfed the bank's available cash reserves. Social media amplified the panic, with news of the bank's troubles spreading rapidly. Venture capitalists, sensing the urgency, advised their portfolio companies to withdraw funds from SVB, further fueling the run. By the end of the day on March 9, 2023, SVB was insolvent, its cash reserves depleted. The bank, once a symbol of Silicon Valley's success, had become the largest bank failure since the 2008 financial crisis. The Federal Deposit Insurance Corporation, or FDIC, stepped in to take control of SVB, marking the beginning of a long and uncertain road to recovery. With the collapse of SVB, the US government faced a crisis of confidence in the financial system. The failure of a bank so deeply intertwined with the tech industry had the potential to trigger a domino effect, impacting businesses and investors far beyond Silicon Valley. On March 10, 2023, the FDIC announced it was taking control of SVB. The FDIC guaranteed all deposits, even those exceeding the insured limit of $250,000, using its deposit insurance fund. This decisive action helped to calm nerves and prevent a wider panic in the banking sector. Simultaneously, the Federal Reserve announced a new emergency lending program, the Bank Term Funding Program, or BTFP. This program was designed to provide liquidity to banks facing similar challenges to SVB, offering loans against the value of their assets. The government's response to the SVB collapse was swift and comprehensive. It demonstrated a commitment to safeguarding the financial system and preventing a repeat of the 2008 crisis. The actions taken by the FDIC and the Federal Reserve helped to contain the immediate fallout from SVB's collapse. The collapse of Silicon Valley Bank left a void in the financial landscape, particularly for the tech startups and venture capital firms that had relied on the bank's specialized services. The FDIC, now in control of Silicon Valley Bank, faced the daunting task of resolving the failed bank. Finding a buyer for the entirety of Silicon Valley Bank proved challenging. The bank's complex balance sheet, laden with long-term bonds that had lost value, made it an unattractive acquisition target. Ultimately, the FDIC opted to sell off parts of Silicon Valley Bank to other financial institutions. First Citizens Bank, a regional bank based in North Carolina, acquired a significant portion of Silicon Valley Bank's assets, including loans and deposits. Other assets, including Silicon Valley Bank's venture capital arm, were sold separately. The resolution of Silicon Valley Bank took time and involved complex negotiations. The Silicon Valley Bank case underscored the need for regulators to have the tools and expertise to handle similar situations in the future. While the epicenter of the SVB collapse was Silicon Valley, its tremors reverberated across the globe. Financial markets, already on edge due to rising interest rates and geopolitical uncertainty, reacted swiftly to the news. Stock prices of banks worldwide tumbled as investors reassessed the stability of the financial sector. The SVB collapse served as a stark reminder of the interconnectedness of the global financial system. What began as a localized bank run in California quickly morphed into a global crisis of confidence. Investors, spooked by the speed and severity of SVB's demise, began to pull back from riskier assets, including tech stocks and emerging markets. Startups that had relied on SVB for banking services were forced to scramble for alternative financing, potentially hindering their growth plans. The uncertainty injected into the global economy by the SVB collapse had a chilling effect on investment and economic activity. The SVB saga underscored the importance of robust financial regulation and international cooperation in managing systemic risks. The collapse of Silicon Valley Bank, while a singular event, offered a multitude of lessons for investors, regulators, and the financial industry as a whole. It served as a stark reminder that even in the 21st century, with sophisticated risk management tools and regulatory oversight, bank runs remain a possibility. One key takeaway is the importance of understanding and managing interest rate risk. SVB's heavy investment in long-term bonds, while seemingly prudent in an era of low rates, proved disastrous when rates rose sharply. Banks must actively manage their asset portfolios, ensuring they are appropriately positioned for different interest rate environments. The SVB collapse also highlighted the dangers of concentrated risk. SVB's reliance on a single sector, the tech industry, magnified its exposure to any downturn in that sector. Furthermore, the speed and ferocity of the bank run on SVB underscored the importance of maintaining ample liquidity. By learning from this experience, strengthening risk management practices, and adapting to the evolving financial landscape, banks can mitigate the risk of future crises. The collapse of Silicon Valley Bank sent ripples through the financial world, prompting a wave of introspection and debate about the future of banking. One key trend accelerated by the SVB collapse is the digital transformation of finance. Fintech companies, with their innovative products and services, are increasingly challenging traditional banks. From online payments and lending to robo-advisory and blockchain-based solutions, fintech is reshaping how financial services are delivered and consumed. The SVB experience also highlighted the importance of building trust and resilience in the financial system. Customers, shaken by the bank's collapse, are demanding greater transparency, accountability, and security from their financial institutions. Banks that prioritize customer centricity, invest in robust cybersecurity measures, and embrace ethical practices will be best positioned to thrive in this evolving landscape. As technology continues to disrupt traditional banking models, regulatory frameworks must adapt to ensure stability, innovation, and consumer protection. The future of finance is being shaped by a confluence of factors, from technological advancements to evolving customer expectations. In the aftermath of the collapse, Silicon Valley Bank was acquired by a consortium of private investors. This move was aimed at stabilizing the bank and restoring confidence in the financial system. The acquisition marked a significant step in the recovery process, ensuring that the bank could continue to support innovation and growth in the tech sector. The consortium, composed of industry veterans and financial experts, brought a renewed sense of direction and stability to the beleaguered institution. Their immediate actions included infusing fresh capital, restructuring the management team, and implementing rigorous risk management protocols. This acquisition didn't just stabilize Silicon Valley Bank. It also sent a powerful message to the market. It demonstrated that even in the face of significant setbacks, recovery and revitalization are possible with strategic intervention and leadership. the bank's new owners were committed to preserving its legacy of innovation, while also ensuring that past mistakes were not repeated. As the bank began to regain its footing, it continued to play a crucial role in funding startups and tech companies, thereby fueling the engine of innovation in Silicon Valley. This recovery phase marked a new chapter, not just for the bank, but for the entire tech ecosystem that depended on it. The acquisition and subsequent stabilization efforts highlighted the resilience of the financial sector and the importance of strategic interventions in times of crisis. It was a testament to the enduring spirit of innovation and the relentless pursuit of progress, even in the face of adversity. In conclusion, the collapse of Silicon Valley Bank sent shockwaves through the global economy, highlighting the vulnerabilities in the financial system. However, the swift intervention by the government and the eventual acquisition by private investors helped to mitigate the impact. As we move forward, it is crucial to learn from this crisis and implement measures to prevent such occurrences in the future. The resilience and adaptability of the financial sector will be key to navigating the challenges ahead. This crisis serves as a stark reminder of the importance of vigilance and proactive measures in the financial world. It has underscored the need for robust risk management protocols, transparent regulatory frameworks, and a culture of accountability. The lessons learned from the Silicon Valley Bank collapse will undoubtedly shape the future of banking, encouraging institutions to prioritize stability and sustainability over short-term gains. Moreover, this event has sparked a broader conversation about the role of financial institutions in society. It has highlighted the need for banks to not only support economic growth, but also to act as stewards of financial stability and public trust. As the industry continues to evolve, it is imperative that these principles guide its development. Ultimately, the Silicon Valley Bank crisis has been a catalyst for change, prompting a re-evaluation of the financial sector's practices and priorities. By embracing these lessons and striving for continuous improvement, the industry can build a more resilient and inclusive financial system for the future. The road ahead may be challenging, but with a commitment to innovation and responsibility, the financial sector can emerge stronger and more capable of supporting the needs of a dynamic and interconnected world. The collapse of Silicon Valley Bank, while undoubtedly a painful chapter in financial history, also serves as a catalyst for positive change. It has forced a much-needed conversation about the role of banks in the 21st century, prompting a reassessment of risk management practices, regulatory frameworks, and the very nature of banking itself. The banking industry is not standing still. Lessons from the SVB collapse are being internalized, leading to a wave of reforms and a renewed focus on risk management. Banks are strengthening their balance sheets, diversifying their portfolios, and enhancing their liquidity positions. They are also investing heavily in technology, both to improve operational efficiency and to better serve the needs of digitally savvy customers. Regulators, too, are taking steps to prevent similar crises from occurring in the future. They are revisiting capital requirements, stress testing models, and supervisory practices. The goal is to create a more resilient and adaptable regulatory framework that can keep pace with the evolving financial landscape. The future of banking is not about preserving the status quo, but about evolving to meet the needs of a rapidly changing world.